Thank you. Good morning, and apologies for the problems this morning, which we'll take up with our provider after this call. I'm Howard Milliner, Wellington CFO. Welcome to Wellington's Investor Conference Call. You will no doubt have seen our 2019 annual report released on February 28th and the latest update on the potential impact of COVID-19 on our business. The call today is to provide you with the opportunity to ask questions of Greg and myself. I'll start with the usual warning. We'll be making some forward-looking statements on this call today, and as these are predictive in nature, they're subject to a number of risks and uncertainties relating to Wellington, its operations, and the markets in which it operates. Some things are beyond the control of Wellington, and the results and conditions may differ materially from those expressed or implied by such forward-looking statements. We're not going to dwell overly on 2019. We were delighted to achieve continued revenue growth and produce Wellington's first ever net profit. But as you can appreciate, 2020 is already presenting its own challenges. For 2019, we were pleased to be able to report a maiden profit of $448,000 on the back of revenue growth for our IoT business and margin improvement from an improved sales mix. The profit is modest, but is a further sign that this business can deliver for shareholders. Revenue for the year ended 31 December 2019 was $61.7 million, up 5% on last year. Wellington Connect IoT revenue increased 31.6% to $24 million. This represents 39% of the total revenue for 2019 compared to 31% for 2018. ECR2 revenue increased 26.3% to $22.5 million, almost replacing the reduction in legacy motor revenues which we'd previously signalled. Gross margin increased from 24.3% to 27%. Product costs were generally lower than last year, although pricing for legacy motor products was also lower to certain high-volume customers to maintain competitiveness. You may have now noticed that we report IoT as a separate segment in our annual report. This segment reporting shows revenue of $24 million for the IoT segment in 2019 and gross margin of 40.8% versus 37.7% and 18.2% for motors. The analysis shows the growing contribution of the IoT business and that motors still make a significant contribution to group overheads. The motor contribution will become less significant over time as we expect more growth from our IoT product offering, which includes hardware, software, and data solutions. Earnings before interest, tax, depreciation, amortization, and impairment was a profit of $4.2 million, a $1.8 million improvement over 2018. If the iProximity fair value gain is removed, EBITDA would have been $3.8, a $1.3 million improvement. This result was in the middle of our guidance range. As stated earlier, the profit for the year was $448,000. The result included a $290,000 impairment charge for previously capitalized development to de-risk the balance sheet. Cash at 31 December 2019 was $3.5 million compared to $0.9 at 31 December 2018. All high interest rate debt was repaid during the year, and we are currently paying below 6% on our BNZ $2 million trade finance facility. I should make a comment on current cash levels. As of today, we have a little under $4 million cash at bank. Our forecast still considers considerable investment levels for the 2020 year, so that gives us flexibility around delaying CapEx and staffing decisions until the COVID-19 position becomes clearer. At present, we would still make reasonable investments where a delay would impact revenue growth or critical product development activities. At this point, I'll hand the call over to Greg to update on some of the growth initiatives we are pursuing and for further comment on how we're responding to the coronavirus situation. I'll let you give you more colour on 2020 guidance. I'm happy to take questions after Greg is presented.
Thanks, Howard. Hi, everyone. Apologies once again for the late start on the call. I guess with half the world now working from home, we're going to have to live with some of these challenges around IT infrastructure globally. So we're back on, and here we go. Our strategy is focused on growing our IoT business with large food and beverage customers, accessing new markets with IoT proximity marketing solutions, and expanding our customer base for our ECR2 motor platform. The strategy is delivering year-on-year revenue growth and improved profitability. We do think it's important we continue on this path as best possible, even while we are responding to the COVID-19 pandemic. In our annual report, we defined our priorities as follows for this year. Number one, successful launch of our new products, the Connect Monitor retrofit solution, our cost-optimized Connect SCS controller, and the ECR2 Plus motor. We do have customers waiting for all these products, although launch timelines and adoption rates may be impacted due to the impacts of COVID-19. Number two, successfully starting the new IoT partnership, which was previously announced with a North American cooler manufacturer, including developing a special Connect SCS solution and customized software apps. We are making good progress on the products needed to support this partnership. We anticipate these products would start to contribute revenue late 2020, with full volume not occurring until 2021. Number three, launching new Connect SCS products, including enhanced retailer apps and Connect reporting tools for cooler fleet management. These new software products will help us sell more Connect SCS solutions, and with the new apps, we'll also provide new channels for our proximity marketing platform. Number four, developing new markets and customers for Wellington's iProximity marketing platform, and we're working on a number of new bids for that marketing platform, which include beverage coolers and ambient food applications. And number five, developing software design and support capability closer to customers. We're exploring ways to expand our software capability to ensure skills that are needed close to customers, such as product owners and business analysts, are in place. Of course, all these priorities ensure we have actions aimed at expanding our software and hardware portfolios, continue to grow revenues with existing and new customers, and expand margins. While these priorities remain a key part of our day-to-day activities, they have been overtaken in the short term by ensuring we respond appropriately to the COVID-19 pandemic. Priority is being given, therefore, to ensuring we keep our team members, customers, and partners safe. We are also primarily focused on working with customers to ensure we keep delivering their needs, and with our suppliers to improve and maintain supply. To that end, the engineering team is busy approving new alternate components as necessary, and the supply chain is working diligently to find creative ways to get products to customers. Very important, as the world's logistics services are currently strained. Now, since our initial COVID market update on February the 13th, our supply chain continues to improve, as noted in our market update on March 16th. Factory capacity in our East-West Vietnam factory is at normal levels, and production in our Matchwell China factory is online, albeit at reduced capacity, but improving. Hardware component supply has improved considerably, and we have improving visibility across all components. We do remain cautious about whether this will sustain, but it does seem like China is coming back online, and our factories are up and running. In short, we are open for business. So as a result of these improvements in the supply chain, Wellington's first quarter revenue forecast has improved to a level similar to 2019. And whilst this is below planned expectations, it is certainly better than when we envisaged back at the beginning of February, when we effectively had zero visibility from our Asia-based supply chain. We've also been talking to all of our customers and our suppliers and receiving updated demand and supply timelines. We're seeing a range of responses on demand, from potential demand decreases to relatively normal demand levels, and indeed one customer indicating they may increase demand as their response to COVID-19. Given this range of responses, we are now assuming a longer period before planned production and shipping patterns may be possible, with the end of Q2 and into Q3 more likely before some degree of normalization. We do not think that all the demand and supply delays will be perishable, so we're anticipating the level of catch-up later in Q2 and into Q3. As already disclosed, our forecast models are built around approximately $6 million of revenue moving to the right and recovering by Q2 and into Q3. Our current risk scenario shows that if $6 million of revenue did not recover, the full-year reduction of revenue would take 2020 forecast revenue to around 65 million New Zealand dollars. This would be below our initial guidance for 2020 of 15% revenue growth, but higher than our financial year 2019 result. As I'm sure you can appreciate, the situation with COVID-19 and the restrictions being mandated by governments around the world are changing rapidly. We would therefore caution our shareholders that the deteriorating global economic situation and those restrictions mean that potential volatility around 2020 is high. Wellington typically only has around 60 to 90 days forward order visibility of customer demand, and so the outlook beyond second quarter has low certainty. Given this backdrop, a wide range of revenue and earnings outcomes is possible. Finally, we intend to provide regular updates on how the business is progressing, particularly with the backdrop of COVID-19. We're happy to take questions now. I hand it back to the operator and you can facilitate questions. Thank you.
Yes, sir. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. To ask a question, you will hear an audible prompt letting you know that your line is open and live. Please be sure to announce your name and affiliation before asking your question. Again, please press *1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. Take our first question. Caller, please go ahead.
Hello, it's Kevin Bennett from Harbour. Greg, could you just touch on what sort of constraints or issues you're facing with just sourcing raw material for your factories versus just manufacturing them themselves?
Yeah, no problem, Kevin. Actually, sourcing has improved a lot over the last 6 weeks. When we made our initial update on COVID back in February, we literally had zero visibility out of China. Factories were closed. They weren't giving us any forecast on supply for any components, and I could say that across the board. Since then, since that early February update, so as of the update this week, we've got full visibility of all components. Now, we haven't got, I wouldn't say all suppliers are up to full capacity yet, but they're forecasting, they're giving us commitments to orders, and this is on all components. There are no exceptions. I would say they're still below capacity, but that means we're able to go to customers, here's the date we can commit to your order. I guess the biggest concern on the supply chain right now, Kevin, is probably more the logistics. Freight companies around the world are still constrained in terms of containers going back and forth into Asia and globally, getting products out of ports and to the right places. There's longer lead times on that, and we're having to fight hard for space. We're advantaged because we're a bit smaller, so we can squeeze stuff into the core of a ship versus needing 20, 30 containers in a ship. So component supply, much, much better, and I think improving all the time. And, as long as China continues to improve on the overall COVID situation, I think that would be my only nervousness. That should continue to improve. Logistics still a problem, but we're shipping and we're meeting all of our customers' needs right now.
And just finally, just on the logistics, how much is the sort of change in the air freight, et cetera? I mean, the number of carriers in the aircraft, or is it largely just sea freight for yourselves?
Yeah, it's largely sea freight. From a customer point of view, there's a couple of occasions where we've had to fly pallets of motors into a customer, and a couple of occasions in the last 6 weeks where we've had to move some rotors for our motors, for example, into Vietnam by air. I would say that, they've been very infrequent, very sporadic, so not really material in terms of a cost blowout or anything like that. We are getting stuff on ships. It's just taking longer to find a ship and longer to get there, and we're having to extend lead times with customers. So at this stage, what we are seeing, though, is container freight costs are kind of increasing 2-3x. So we are seeing some increase in container freight costs, but in many of our customers, they pay for that.
Thank you.
Thanks, Kevin.
Thank you. And as a reminder, that is *1 on your telephone keypad to ask a question. Have one more question? Caller, please go ahead.
Hi, Greg. Murray. Hello? Graham Jardine.
Hey, Murray.
Can you just describe the benefit the company's receiving from the New Zealand USD weakness, given that your functional currency is probably USD?
Should I answer that question?
I primed Howard to answer that, so on you go, Howard.
In our annual report, Murray, we do attempt to quantify what the impacts are of currency movement. So roughly in EBITDA terms, every 1 cent movement is 160 grand per annum. We are forecasting, or we did forecast this year at 65. And I do generally take cover out 6 months forward. So I locked in a contract this morning at 59.65, which was very nice. Thank you.
Okay, that's good to hear. Thank you. And predominantly, where are you? Just one other question. In terms of the current logistics, you predominantly shipping into Latin America at the moment?
Yeah, our logistics we've got logistics obviously between China and Vietnam from a supply side point of view. So that's getting better. And then from a customer point of view, actually it's Latin America and the US are our two big destinations. The US for our big motor customer on the East Coast, and then Latin America all across Latin America. So we are seeing, I guess we're seeing more constraints on the US side of late. Latin America seems to be doing okay. We did come into this situation as well, Murray, with thankfully quite a bit of stock in our hubs in Latin America, so that's given us the ability to recover lead times. Obviously those stocks are being bled down now, so those are our logistics parts into the US and Latin America, and then supply side China to Vietnam.
Okay, many thanks.
Thanks, Murray.
Thank you. And once again, if you would like to ask a question, please signal by pressing star 1 now. Take our next question. Caller, please go ahead.
Mike, Daniel here. Greg?
Hi, Mike. How are you?
Yeah. Good, thank you. Probably a question you can't answer, but at what stage can you guys divulge to the market who your main customers are?
Thanks. Good question. With all our major customers, we talk about food and beverage brands. We're actually not allowed by those customers contractually to name them. And in fact, with one of our largest customers, we have to get special permission, and that's very hard to get, to even refer to their brand in any of our literature. So there's some commercial and contractual requirements that stop us from doing that. And there's a good reason for that, I think, Mike. We actually have a reputation in the market with our customers, a very strong reputation of being neutral when it comes to brands. So we can work with competitive brands, food and beverage, and those competitive brands look at us and have actually told us that one of the reasons they do business with us is because they trust that we won't pollute each other's business. In some cases, we don't actually build the same products down the same lines in the factory. So we're very, very careful and we're very sensitive about that, and we keep that confidence. So it's hard for us to disclose that to the market when we have those kind of constraints. And I think we actually earn business with our customers because we're seen as neutral. We're Switzerland to them, and we don't kind of talk about either, all of them. So that's kind of the backdrop, Mike. I mean, I'd love to talk about them if we could, but I just think it actually helps us in the customer market sense.
So, from a genre point of view, can you describe the size? Can you say, well, we supply some of the main drink suppliers in the world, or something like that? It's just that I don't believe the market still doesn't understand the value of your customer base.
Yeah, that's an interesting point. We supply our products to, I would say that, if you thought about the 10 largest beverage and alcoholic drink brands out there in the world, and I mean the largest in terms of market cap and revenue size, we're supplying products to those guys. And that's kind of our strategy, to look for those higher profile, higher volume beverage and food in brands. Now, that said, we actually transact with the manufacturing companies and in many cases the sub-tiers of these brands, but we're marketing to the big brands and convincing them that they should buy our products. So for sure, again, any of those large global beverage and food brands you can imagine, we're probably working with them. I acknowledge that it's an issue that maybe shareholders that's something that they would like to know, but it's not something I'd be prepared to do. I wouldn't want to compromise the confidentiality. And again, we absolutely win business because we are seen as a neutral provider in the market.
Yeah.
Some of our competitors, by the way, and we know this for a fact, are only able to deal with one of those customers because the other customers, don't feel like there's that level of confidentiality, and those competitors might name customers where we don't. So it's very important, I think, that we have that approach. Any input you could give, even offline, on how we could kind of change that without actually talking about specific customers, I'd certainly appreciate offline, Mike.
Well, you just sort of did, and if shareholders could be advised that you do deal with the top 10, and you don't even have to name them. If they've got half a brain, they'll go and have a look. So you're the top 10 food and beverage producers are in the world, and the fact that you guys are dealing with them and supplying to them might wake a few people up.
I've actually mentioned that several times, Mike, on shaping the market. But the more we talk about it, the more people will understand it.
Yeah. Thanks.
Thank you. And once again, that is *1 for any questions. This time, sir, there is currently no questions in the queue.
Okay, just give everyone another minute to see if there's any more questions. Another 30 seconds. No? Okay. Let me just close by thanking everyone for hanging in there for 15 minutes for the delayed call start. Appreciate it. I hope you all are staying safe and practicing social distancing. We are in the company. We're practiced at remote working. Half of our workforce already work from home, and we're very, very well prepared in New Zealand and in Mexico, our two biggest offices, to, if need be, not be in the office and still operate the business, entirely operate the business from home. So we're rehearsed at that, and we're ready to do it should it become necessary. So I wouldn't be thinking of any concern around our ability to run the day-to-day operations if our offices are disrupted. But hopefully all our shareholders are following the instructions from government and staying as safe as possible, and I look forward to updating you all in 4 to 6 weeks' time as we get through this global situation. Thank you, everyone.
Thank you, ladies and gentlemen. This